हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 113, दैट इज फेयर वैल्यू मेजरमेंट पार्ट 3। Discussion in previous discussion we had discussed about the fair value measurements of assets. Now in today's discussion we are discussing how the fair value is measured for liability. Applying fair value rules to liabilities and other equities. How fair value rules are applied in measuring the liability and other equity. Assumption made while carrying out fair value measurements. What assumption we are going to take while measuring the fair value of liabilities. Liabilities means financial liabilities there, that is borrowing is a financial liability. Trade payable, these non-financial liabilities are advance received towards sales of property, plant and equipments. Means any advance received is the non-financial liability. If you are borrowing loan from bank, that is the financial liability. Debtor is a financial liability. Other equity means equity instrument, own equity instrument, that is equity issued by the company as consideration in business combination. Any means in case of business combination, if the entity issue any shares, own equity shares, how measurement is done in that case. In case of business combination, how fair value measurement is to be done. So, what assumption is to be taken while carrying out the fair value measurement? This fair value measurement is measured when the market participants they transfer these liabilities, these non-financial liabilities, these equities to the market participants at the measurement date. Means when they are transferring their liability, they are not settling, they are transferring their liability to they are shifting their burden to the another person. Means they are transferring their liability to the market participants at the measurement date. At that time fair value is to be measured. At that time fair value rules is to be applied. So the liability and or equity instruments so transferred will remain outstanding on the date of measurement. Means the liability which is outstanding on the date of measurement, it is not settled, it is transferred. In case of business combination, like if any merger happens, any acquisition happen, all the assets and liabilities is to be transferred to the another company, the company who acquired the organization. So in that case, fair value is to be done of all the assets and liabilities also. So standard prescribed to use all observable inputs. Observable inputs means the input which is available in the market, the price which is available in the market, that is the quoted price which is available in easily available in the market, and that is the observable input. We take that input easily and put it into the fair value measure. But standard prescribe to use all the observable input. They prescribe three phase to apply the fair value. Means if the price is easily available, then you take it that. If the price is not easily available, then you make some adjustment in level 2. And if you are not able to also adjust that price, then what you will do, you will apply the cost formula, that is the Gordon formula. So there is three methods are there to apply the fair value, to use the fair value, to measure the fair value. So standard prescribed to use all observable input if direct quoted price are not available, and should minimize any unobservable input. Unobservable input means if the easily market price is not available, you will take the price of the similar item and make some adjustment to bring out the exact price of that. So the transaction considered to find fair value should be evaluated in line with an orderly transaction. So transaction considered to find fair value should be evaluated in line with an orderly transaction, not entity specific. Means it's saying that the transaction considered to find fair value should be evaluated in line with an orderly transaction, not entity specific. These transactions are not entity specific. Ind AS 113 specifically provide guidance on the respective scenarios while evaluating fair values of the liabilities and own equity instrument in case direct quoted price are not available. If the direct quoted price are not available, Ind AS 113 provide us a guidance to evaluate the fair value of the liabilities and equity. That's why this Ind AS 113 provides us a guidance to bring out the fair value if the price is directly not available in the liability and other equity instruments of the entity. How the price is to be evaluated, now we will discuss. In your books there is a liability, but in other party there is an asset. In that case, what you will do? Held by other party as an asset. Then how you will evaluate? Evaluate the fair value of that liability. Means held by other party as an asset. Suppose the creditor is in your books, in your liability is there, but the same creditor is the debtor in other books. Loan is taken by you, that is your liability, but loan is given by the bank, that is an asset for the bank. So the liability which is held by other party as an asset, then how you will evaluate? When a quoted price for transfer of an identical or similar liability or equity instrument is not available, means if it is not available, the quoted price is not available, an entity should measure fair value of the liability and equity from the perspective of the market participants that holds the identical item as an asset and at the measurement date. So how they are evaluating for the liability which is an asset in the other book. So there are three criteria, there are three preferences are there. Preference 1 is use the quoted price in active market for identical item, means if you are not getting the quoted price easily in the market, then you will evaluate by using the market participants. You will evaluate the fair value of liability and equity from the perspective of the market participant who hold the similar item as an asset in their books on the measurement date. So how they are evaluating, you will take preference 1 is use the quoted price in an active market. If available, means use the quoted price in an active market for identical item held by another party as an asset if available. Then another one is use the quote price. If the quote price is not available, use other observable input such as quoted price in the market. Suppose the price of the similar item is not present. The value of the share is similar to the Reliance Industries. So you will take the price of the similar item, that is Reliance Industries, make the adjustment and then find out your price. So if quoted price is not available, use other observable input such as quoted price in the market that is not active for the identical item held by another party as an asset. If that is also not possible, then you will go for preference 3. If observable price, that is 1 and 2 are not available, use a valuation technique. Valuation technique means present value of the future cash flow. Use the present value by using various formulas like Gordon formulas, Black-Scholes rules, so such as income approach or market. So in this way you will find out the liability held by other party as an asset. But there are some liabilities which is not held by another party. Suppose in your books, provision for decommissioning cost. You are decommissioned an area by digging the area, and also you have a restoration provision in the future. Means you had done a decommissioning and you have created a liability for that in your book. So at the time of transferring your liability, how you will measure? In case of business combination, how you will measure that? If that item is not present, because there is no such party, you don't know who will do the decommissioning in future, because that is the future cost. That liability is for future, not arise today, and you don't know you will give the tender to whom, to decommissioning and restoration for that. Suppose you had made a tower. You had made a tower, you had made the provision for tower, and also you had made the provision for decommissioning of cost, that after 15 years we have to remove that tower and also make this area in the same way we had taken at the time of decommissioning, at the time of putting that tower on that building. After 15 years there is a time limit, so you have to make the provision for that liability today. For the first time you put a tower on that building, so on the day when you put the tower on that building, the liability arise on that day only, not on the date when you will make the payment for that. So decommissioning is to be done on the date. So provision is to be created on the date when you first time make a tower on that building, and there is a liability arises that after 15 years you have to restore that in the same way in which the party has given you. So you don't know that who will do the, to whom I have to pay the for restoration cost. When a quoted price for the transfer of identical or similar liability or equity instruments is not available, means in your books there is a provision, you had created a provision for that, provision for decommissioning and restoration, but there is no party to whom the asset is there, because the party is not present. Party will be arises in future. So in that time, how you will evaluate that liability? An entity shall measure fair value of the liability and equity instrument using a valuation technique. Then they will use the valuation technique, that present value of the future cash flows. Then they will apply the Gordon formula, Black-Scholes rules. They will evaluate by using the present value of the cash flows. Means they will use the technique how to evaluate that cost today and what they have to pay in future. So by using valuation techniques from the perspective of the market participants that own the liability or has issued the claim on equity. So in this way, the liability is to be evaluated. Now applying fair value rules to the liabilities and own equity. This is the rules we just go through because we had already discussed. Assume transfer and not settlement of liabilities or own equity instruments. Suppose we are assuming, means we are liabilities transfer, not settling the liability or an equity instrument, then what happened? Is there any quoted price? If quoted price is there, yes, then use the quoted price. If quote price is not there, then you will check there is a similar or identical item held as an asset by another party. Held as an asset by another party is there, then use the fair value of that identical asset. Adjust quoted price only if the factors specific to the asset but not to the liabilities own equity are present. Means make some adjustment to that identical to bring out your fair value. And if the fair value is not present, then use the valuation technique, apply present value technique, include expectation of cost or comparison. Now, applying fair value rules to liabilities and own equities. Fair value of liability reflects non-performance risk. Means, what does it mean? Fair value of liability reflects non-performance risk, means it depends on the company ability to repay to its investor. Suppose in case of Jet Airways, value of that company share is 10 rupees, but the market value is 2 rupees. So the market value, the fair value reflects the company ability to repay, whether it will be able to repay to its investor or not. It reflects the true and fair picture of the company, whether whether the investor will invest on that company or not, whether the company has the ability to repay to its investor. So, fair value of the liability reflects also non-performance risk, because in that case, non-performance risk are there because company is not performing well. Market value or fair value represent the company's position, how the company is performing. So it's depend on the company's ability to repay to its investor. So it includes entity's own credit risk. Now transfer restriction. In some cases there are some transfer restriction. No separate input or adjustment is required. So fair value is required for that. Financial liability with demand feature means there are some liabilities which is repayable on demand. Suppose cash credit, cash credit taken from bank. That loan is a working capital loan. Bank OD that is taken from bank, and bank will at any point bank will stand and arise कि अरे भाई मेरा पेमेंट वापस कीजिए. So financial liability will depend with demand feature. So fair value is not less than the amount payable on demand. So उतना fair value आपको अपने books में दिखाना पड़ेगा जो कि payable on demand है, not less than. So fair value is not less than the amount payable on demand. Discounted from the first date, the amount could be required to be paid. Cash credit, bank OD. Cash credit is that amount that payable on demand. At any point, bank will come and say that, yeah, please pay my amount. So cash credit, bank OD is that type of payable on demand. Fixed deposit. You are making a fixed deposit and you go to the bank and ask anytime. You had made a fixed deposit of 5 years, but you go to the bank and go and tell, yeah, I require money anytime before the maturity period. Bank will not deny. Bank have to break your fixed deposit at any point of time. So they had to create that liability in their books that they will repay that along with accrued interest. You will not take below accrued interest or principal amount. So that is the demand liability on demand features, that anytime they will stand and say please give my amount. This explanation, whatever we had discussed, we will explain with the help of example. Suppose we had discussed about the decommissioning cost, explain with the help of example. We will taking the example of Rohini Limited, and Rohini Limited, which we had previously also discussed in previous discussion. That is the first part. In second part, we will discuss about the decommissioning cost. Additionally, Rohini Limited acquired an entity on 31st March 2020 and is required to fair value a decommissioning liability. In his books, there is a decommissioning liability and he has to make a fair valuation of that. The entity has to decommission a mine at the end of its useful life, which is 3 years of time. So the decommissioning, they want to decommission, there has a mine and the useful life of mine is 3 years. Rohini Limited has determined that it will use a valuation technique to measure the fair value of the liability. So they had determined that fair valuation of liability is to be determined. If Rohini Limited is allowed to transfer the liability to another market participants, then following data would be used. What was the data? Labor and material cost is there. Labor and material, that is 14 crores. This is the question. Labor and material of 14 crores. Annual inflation rate is 5%. Overhead is 30% of labor and material cost. Risk adjustment cash flow uncertainty is 6%. Third party markup industry average is 20%. Risk free rate of government bond is 4%. Entities non-performance risk is 2%. Now we have to discuss with the relevant computation how Rohini Limited should measure the fair value of the above assets and liabilities under Ind AS 113, how they will measure. So this is the solution Fair value of decommissioning liability. Firstly, we will discuss it. Already discussed the decommissioning, what decommissioning is, and restoration is. Once you dig out, after a certain period, you have to restore that place in the same way in which you had dig out. So fair value of the decommissioning liability. Since this is a business combination, the liability must be measured at fair value under Ind AS 113, rather than using best estimate measurement required by Ind AS 37, that is the provision, contingent liability and contingent. So this is a big business combination. Liability must be measured at fair value under Ind AS 113. So it should be measured at fair value rather than using best estimate measurement required by Ind AS 37, that is provision, contingent liability and contingent asset. In most cases, there will be no observable market to provide pricing inflation. So in most of the cases, there will be no observable market to provide pricing information. So observable market is not present in this case. If this is the case, Rohini Limited will use. If observable market is not used, if not present, if level 1 is not present, if level 2 is not present, then they has to go for level 3, that is the valuation technique. So if this is the case, Rohini Limited will use expected present value techniques to measure the fair value of decommissioning liability. So they use the cost method, future value, present value of the future cash flows. If Rohini Limited were contractually committed to transfer its decommissioning liability to a market participants, means they contractually decommission to the market participant, it would conclude that a market participant would use input as follows, arriving at fair value of 22 crores 50 lakh 13,617. So this is the fair value. Now how it is to be computed? Firstly, labor and material cost is given in the question, that is 14 crores. Overhead is 30% of the labor and material, that is 4 crores 20 lakhs. So total becomes 18 crore 20 lakhs. Now third party markup is industry average. What industry average rate? So industry's markup is 20%. 20% of the cost, total cost. On total cost, markup is to be given industry's markup, that is 18 crore 20 lakhs, on which the 20%, that is 3 crore 64 lakhs. Now total becomes 21 crore 84 lakhs. Now inflation is to be adjusted. What inflation rate going on the market? 5% compounding over 3 years. So compounding rate is to be given, that is on total cost compound. It is compounded at a rate of 5%, because in this case compounding rate is given, that is in question. The labor and cost is annual inflation rate is 5%. So this is the useful life of mine is 3 years. So for 3 years it should be compounded. So inflation adjustment rate is 5% compound over 3 years. So it should be compounded for 3 years. So 21.84 into 1.05 to the power 3. For 3 years we are compounding. So it becomes to the power 3. So it becomes, 25 crores 28 lakhs 25,300. After giving the inflation effects on that. Now risk adjustments, we have to take the risk also. What was the risk of uncertain cash flows? Risk is given, that is 6% is risk cash flows uncertainty, and so 6% is cash flow uncertainty. It is also adjusted over inflation rate, means after giving the inflation rate. So 25 crores 28 lakhs 25,300 into 6% inflation, means 6% risk adjustments on inflation. So 6% risk adjustment on total cost after giving the inflation effect. So risk adjustment is 6%. So it becomes On 25 crores, 28 lakhs, 25,300, 6% inflation risk adjustment adjusted. So it becomes 1 crore, 51 lakhs, 69,518. So total becomes 26 crore, 79 lakh, 94,818. Now it will be discounted at risk-free rate plus entity non-performance risk, which is already given in the question. Risk-free rate and non-performance risk is, risk-free rate is 4% and entity's non-performance risk is 2%. So 6 plus 2, 4 plus 2 is become 6, and it is this risk-free rate plus entity non-performance risk is for 3 years. So on 26, after giving the inflation effects, after giving the risk adjustment, cash flow uncertainty, whatever arises on that, risk-free rate plus entities non-performance risk is to be adjusted. That is 26 crores 79 lakhs 94,818 6% into divided उसका प्रेजेंट वैल्यू आपको आज लाना पड़ेगा. After giving this effect, discount at risk free rate plus entities non performance risk उसको प्रेजेंट वैल्यू में पुल करना पड़ेगा, क्योंकि आप तो इन्फ्लेशन 3 साल के बाद कितना टोटल इन्फ्लेशन का इफेक्ट दे चुके हो, उस पर रिस्क का एडजस्टमेंट दे चुके हो. अब आज के दिन उसका क्या वैल्यू है उसको डिस्काउंट करके लाना पड़ेगा. डिस्काउंटेड एट रिस्क फ्री रेट, रिस्क फ्री करके प्लस एंटिटीज नॉन परफॉर्मेंस रिस्क को हटाने के बाद, सो उसको पुल करके लाएंगे 26 crore 79 lakh 94,818 divided by 1.06 to the power 3. So it 22 crores 50 lakhs 13,670. So 22 crores 50 lakhs 13,670 is the present value, is the fair value contractually committed to transfer decommissioning liability to a market participant. 22 crores 50 lakhs 13,617. It would conclude that the market participant in use input as follow, arriving at a fair value 22 crores 50 lakh 13,607. Now applying fair value rules to the financial assets and financial liabilities with offsetting positions in the market risk or counterparty credit risk, whether the financial liability and financial asset will be offsetted as per these NDAS 113. It provides that if the trade receivable is in USD and liabilities also is in USD, if the financial liability is in USD and the financial asset is also in USD, then it will be in a position. If the forex gain is there in one case and forex loss is there in other case, it should be set off. Set off is permissible in that case. That is, if trade receivable and liability is in USD and there is a forex gain in one case and forex loss is another case, set off of forex gain and loss is permissible as per NDAS 113. Also, the fair value on net basis is permissible. Means the fair value on net basis is permissible in case of if the price receivable to sell net long position and price payable to transfer net short position. Fair value on net basis is permissible in case of price receivable in to sell to if you sell the net long position paying any short position, so that net long and short is to be offsetted with each other. So documents risk management investment strategy is there, info to key managerial person, fair value at the end of each reporting day. Now analysis of applying offsetting position in the market and credit risk. What analysis we will do while offsetting positions in the market or credit risk? This exception is allowed only in case the other market participants also manage the similar risk on net basis. Means offsetting is only allowed if the market participants also manage the similar risk on the net basis. There should ideally the same information and market practice available for making these assets and liabilities on net basis. Means there is a market practice should be available that assets and liabilities should be offsetted with each other on net basis. Once the exception to fair value certain assets and liabilities on net basis is being used, then unit of accounts to measure the fair value would be considered as net. Market risk should be same. While combining any assets, liabilities, interest rate risk cannot be netted with commodity price risk. So market risk should be same. Market risk should be same while combining any asset liability. Interest rate risk cannot be netted with commodity price risk. So interest rate risk cannot be netted with commodity means if interest rate risk is there and commodity price is there, it cannot be netted off. The market participants practicing the same kind of should be ideally the same information market practice available for making these assets and liabilities on net basis. So market practice should be available. If market practice is not available and there is a different nature of risk are there, so it cannot be netted off. Duration of market risk should be identical to use the exception for valuing assets and liabilities on net basis. So that is also means they are saying that market risk should be identical to net of the assets and liabilities. Now fair value of initial recognized. An entity A Limited. An entity A Limited acquire an asset or assume a liability from B Limited in a normal market run. A Limited enter the transaction and B Limited exit the transaction, and therefore for A Limited transaction price is the entry price. Fair value at initial recognition means an entity acquire an asset. Suppose entity A is there who acquire an asset and entity B transfer its liability in a normal market transaction, or entity B assume a liability in a normal market transaction. For A Limited enter the transaction and B Limited is exiting the transaction. Means for B Limited it is the liability who want to transfer its liability and A Limited is acquiring an asset. So for A Limited the entry transaction is there and for B Limited the exit transaction is there. In the normal market condition, what happened for A Limited, the transaction price is the entry price because he is entering into the transaction in the normal market situation as per Ind AS 113. For B Limited, the same price, whereas the same price for B Limited is the exit price because fair value is the exit price. As we know that fair value is the exit price. For one it is an exit price, so for another entry, for another entity to enter into the transaction, for them it is the entry price. For one it is a liability, so for another it is an asset. For one the fair value as per Ind AS is exit price, for another it is an entry price. So entry price must be equals to exit price as per Ind AS 113. But there are some special cases, some special situation, some exceptions are there where assets and liabilities are not measured equally. Means exit price is not equals to entry price. What was the situation? In case of related party transaction. In case of related party transaction, suppose goods sold in a group companies or to the related party, then it should not be measured at fair value. Means the entry price is not equals to the exit price in that case. Suppose seller sells on stress condition. If the seller is not in a position to run a company and he has to discontinue and want to sell its company because his company is working well, so he wants to sell if he is in a stressful situation and he requires money in order to pay off their duty, means they pay off their creditors or liabilities, or so in that case, what was the situation? Sold goods under stressful situation, when company is under liquidation process, or when the company is unoperating. So they sell at a lower than the market value. So that case, fair value is not used. Now, different units of accounts, slum sale. We can say that a unit of account is to be sold by the entity as a slum sale. Slum sale means as a whole, as a one division is to be sold. Means in its books, they are selling as division, but the entity who is purchasing that division, they will recognize separately the item which they had purchased in their books. They will not recognize as a dump sale, dump purchase. So but the seller recognize in his books as slum sale, selling as a unit, but the person who is purchasing that unit, they will recognize each and every item separately in its book. Suppose in slum sale, everything is there: property, plant, equipment, inventories, debtors, liabilities, everything is there for in whatever it is there in unit. So the seller sell as a slum sale, they will recognize in its books as a slum sale as a whole, but the purchaser who purchased that unit, they will recognize each and every item which they have purchased on slum sale basis. On slum sale, they will recognize separately. They will recognize inventory separately. They will recognize property, plant, equipment separately. They will recognize data separately. Whatever they had purchased on slum sale, they will recognize separately in their books at fair value. So that in that case, exit price is not equals to the entry price. And also in that case, transaction not happening on principal and most advantageous market. If principal market is not present, if most advantageous market is not present, then they will use sold goods to the entity specific. So in that case also, fair value transaction, in that case also, entity price is not equals to exit price as per Ind AS 113. So there are 4 exceptions. Related parties sales under stressful situation, different units of account as lump sale, and transaction not happening on principal or most advantageous market. Then in that case, fair value is not equals to exit price, is not equals to entry. Transaction price is minus fair value equals to profits, which is to be recognized in PL if cannot be attributed to transaction cost. Now, what was the disclosure we have to give? Disclosure is required in each and every standard. We have to give for each and every standard. Disclosure is to be given in the financials. So what disclosure we will give? An entity should disclose information that helps user of the financial statement to assess both of the following. Means the user of the financial, how they will assess. If you will not disclose in the financial, it will helpful for the user of the financial statement take decision on the basis of that financials. So what they are assessing for assets and liabilities that are measured at fair value on a recurring or non-recurring basis in the balance sheet after initial recognition, the valuation techniques and input used to develop those measures. For recurring fair value measurements, using significant unobservable input, that is level 3 input, that is we use the valuation technique in that. If the observable inputs, level 1 inputs and similar observable inputs are not available, the effect of the measurement on profit or loss or other comprehensive income for the period. So this disclosures is to be given as per this standard. Disclosure is required to be given. Thanking you for watching my video. If you like, please share, subscribe my channel. Thanking you for watching.